So get this, one of my members took their account in my premium option trading group from 12K all the way to 25K in one single week. He doesn't have to worry about the pattern day trading restriction, and he did this primarily with option trading. Option trading is incredibly powerful for everyone in the stock market, and the problem is nobody is teaching it well on YouTube. I'm going to change that today. I'm going to give you the most in-depth tutorial so you can make money with options tomorrow with Robinhood. Stay tuned. And just a quick reminder, I've been trading options professionally for 5 years, and I run a professional options trading group, so you should be subscribing to this channel if you want to know everything options all the time. So in this complex video, A to Z tutorial on option trading, I'm going to go over everything you can imagine. What is an option? How do you make money from it? How can you lose money from it? Which situations is best to trade it? How do you trade complex option strategies, strangles, straddles, the best stuff that the best traders use? And then lastly, at the end of this video, I will tell you my best setups with option trading right now. I'm going to explain options in depth until 4 minutes, and it might be more in depth than you need. So if you're a day trader, just skip over to 4 minutes. It might be better for you. So first question goes to Bob, way in the back. Bob, what do you got? And he's going to say, what is an option? And Bob, this is what an option is. All we have to do, just go to the definition of it. I'm going to tell you right here. It's basically a contract that gives the buyer the opportunity to buy a certain stock at a certain price on a specified date. That's all the option is. Date, price, and we're buying shares. Or we flip it again, we could be selling shares if we are doing puts. So that gives you the right to sell shares of stock. Just to let you know, I got a free options trading course on my website. Please take advantage of it. We give away free stuff every single month. Now you're probably asking yourself, how many shares do these contracts control? And it's pretty easy. With these options, every single option you're seeing on the option chain, this is what we call the screen of all these different strike prices, they control 100 shares of that stock. So at any point, you could be buying or selling 100 shares if you exercise the option. And you might be asking yourself, what does it mean to exercise an option? So once you buy the option, like I said before, it gives you the right to buy or sell 100 shares of that stock at a specified strike price. If you exercise it, that is you actually doing that process of buying or selling 100 shares of that stock at the specified strike price. You don't have to. You have the right to exercise, but you don't have to. Let's say, for example, your option expired in the money, meaning you have that right at expiration to exercise. If you opt out not to and you don't exercise, nothing happens. You might end up keeping that premium if your broker can help you out, but normally you lose the premium, you don't exercise, nothing happens. That's the worst thing that can happen during expiration, is you just lose all your money because you didn't do anything to exercise or take advantage of the premium at least. And yes, you can exercise that contract at any given moment, even before expiration. So an option just gives you the right to buy or sell the option at the underlying price, the strike price, at the exact date. So you could do it prior or before the specified, prior or on the specified date. What does that mean on Robinhood? So let's go to Robinhood. As you can see, we have a couple columns: strike price, break even, to break even, percent change, change, price, all that stuff. And up here we have buy, sell, call, put, and then up top we have the expiration date. So for example, if I bought this CGC put at 18.5, I would be able to sell 100 shares of CGC at 18.5. It would basically help me lock in a certain amount that I want to sell it at any given moment. So this could be good for traders if they don't want to risk anything in the market, if they want to make sure at this moment in time they have a contract that lets them sell it at an exact price. This is not something any option trader cares about. So everything I'm teaching you right now, no option trader really cares about, because what we're doing as option traders is we're buying this 18.5 put and we're just playing direction. We're playing either the up or down movement in the stock, and we're trying to sell it before it expires on this date. So if you click this button here, you can see a bunch of dates for this option. So every date is going to make the option more expensive. I'll get into why later in the video, but All we want to do is just trade the oscillations in the stock with this option. And the reason why we do that is simple. Again, it controls 100 shares of stock. So how much could you make if CGC moves $1? And this is why option traders are excited to do this, and this is why they're using options instead of stocks. So if we move down, which is the direction of what a put is, we would have 100 shares for this 18.5 put. This cost me $217. If I do the math, 18.5 times 100, you would have to buy $1,850 worth of stock to get the same movement from a $200 option. Does this make sense, guys? This is why it's exciting. This is why everyone flocks to options. You can get leverage. With small amounts of money, I can get the same move as having a $2,000 investment in CGC. So for 200 bucks, I get the same exact movements and the same exact returns as a $2,000 short on CGC. Now let's talk about more what the option intrinsics are, what calls and puts are. So calls and puts. Calls are when you're betting on the direction of the stock to move up. And puts are when you're betting on the direction of stock to move down. So this is why options are tough for traders, because they have to be right about the direction. And then, they have to pick the right expiration date, because when we're trading options, we want to get out before the options expire. There's some bad things that happen when they expire. I'm going to get into that later on. But when you're trading, the more time on your option, the better it is for traders, because they can be wrong and we wait longer to be right about the actual direction of that. Now I want to explain something very confusing, but this gives traders the edge, and this is how people lose and make money with options. If you don't understand this, you will lose so much money with options. So there's something called the Greeks, and the Greeks can be found if you click the exact option you're looking for on the option chain. So if I click this 19 put, there's going to be a bunch of Greeks down here. And it's funny because on Robinhood, they actually call them the Greeks, and they list them out for you. So we have Delta, Gamma, Theta, Vega, and Rho. I'm going to go over all of those, how they can help you and how they can hurt you. It's pretty obvious, guys. If it has a negative sign, it's going to hurt you. If it has a positive sign, it's going to help you. But this one here, Vega, this one can help and hurt you if you don't know about it. So that's a very key one that I'm going to go over too. So let's move to the first one, which is Delta over here. This is going to be the measure in the change of the option price when the stock moves. So basically, it tells me how many shares I control at any given moment for the stock. And the thing with an option is that you have to multiply every number by 100 to really know how much that is for you when it comes to dollars. So right here, the option costs 2.17. That's not $2, guys. You have to multiply that by 100. That's $217 it's going to cost you. So you always have to multiply the Greeks and the option by 100 to really know how much you're going to pay and how much that change is going to help or hurt you from a P&L standpoint. So again, 46. What does that mean? To me, the option trader, it means if the price of the option or the stock goes down $1, I'm going to make 46. Because I control right now 46 shares of this stock CGC. So 46 shares I control. Therefore, if it goes down $1, I make $46. Let me show you something interesting here. So 46, if this drops $1, is going to make me about, it looks like 20-ish%. But let's just type it in so we can see it perfectly. It will make me 21% return if I get $1 move in CGC. So again, this is why it's so exciting for everyone in the market, because where else can you get 20% return off a $1 move? That's a very, very simple thing. And the higher you go, let's go down. The higher you go up the option chain, the more shares you're controlling. So again, we were looking at the 19, which controlled 46 shares. If you move up to, let's say, 20, now we're controlling 57 shares. So check this out. This also changes how much you would possibly make. So if I click this option again, this is a $200 option. So if I move down $1, I would be making $57. That's actually more than the last one. So that's going to be about 28% return. So depending on where you are on the option chain, you could be making more or less. And I'm going to go down here just a little bit. Let's go to the 17s. These control about 25 shares of this stock, the 17 strike price. And we'll go over what strike price is in a second, but if I type in 25 divided by 63, we're going to be making about 30 or 40-ish percent. So that's a very key thing for option traders. The further you go down, what we call out of the money, the more you can possibly make. And that's very, very interesting, very exciting. And let's talk about what in the money, out of the money, and at the money is. So we have three things called in the money, out of the money, and at the money. This is just talking about the option chain. And all the option chain is the list of options you can buy. And this is kind of squeezed together. I'm going to pull it up on a different screen. So this is what you normally see on a platform like Thinkorswim. This is a highly professional platform. I recommend everyone tries it out. But on the left side over here, we have calls. On the right side, we have puts. And in the green, this is considered in the money. On the green over here, it's considered in the money. As you can see, they're inversed because one goes up, you make money. One goes down, you make money. When it's white, it's considered out of the money. It's very important for this one simple fact. If it's out of the money and it expires on expiration day, it's going to expire with no intrinsic value, meaning everything in the white is going to zero on expiration day if the price doesn't move. This is options. We're trying to make money from movements in the market. So if it doesn't move, we're really going to get hurt. And that's going to apply to one of the Greeks we're going to be talking about soon. But basically, if we're in the white, we're going to expire worthless. That's very scary for traders if you're holding them. So every day you're losing money. But if you're in the green, you could still be losing money, but you're not going to go straight to zero, which is nice. And what we call this line here, this is where the green turns to white. It's called at the money. And for me as an option trader, I like trading things that are kind of out of the money. That's what I do in my premium option trading group. If you want to try it, 7 days for free, link in the bio. But we like to stay a little bit out of the money. And just because, for the simple fact I showed you earlier, you make more when the stock moves. So if I go to these March 20th ones, you can see that the price movement down here is a lot more. We have about 100% return there, 30%, 40%. It just, honestly, it's not reflecting too well on Robinhood because it's a pretty bad platform. But usually, if you're out of the money and something moves in that direction, the ones furthest out of the money are going to make the most percent return. The further you go in the money, which is going to be further into the greens, that is where you're going to get less per dollar move. You're not going to make as much because of some of the Greeks factored in. Now let's move on to the next Greek. This is going to be gamma. So this is going to be the measure of the change in delta when the stock price moves. So like I said, you control more shares of the stock when you're on certain strike prices. So like I was saying previously, for puts, the further we go in the money, the more shares we control. 57 shares, 21 we control 65 shares. And the key for that is every dollar move, you're going to control more and more shares, which means you make more and more whenever the stock moves down, because this is puts. We're talking about puts. That means if it moves down, we are making money. So gamma right here is 11. So that would be added towards delta if the price of the stock moved down $1. So that means I would control 57 shares. And again, if we move from 19 to 20, that's about 57 shares right there. So that's really correct because as you can see, it's reflected on the option chain right here just on Robinhood. So that just means the next time it moves down $1, instead of making $46, you're going to make 57. And the next time it moves $1 from there, you're going to be making whatever 11 plus 57 is, 68. And eventually, the max you can make is 100 because that is the max you can control at any time. So we have to scroll up really high to control 100 shares. 27, 29, this controls 82. So if we keep scrolling, we get closer and closer to that 100. But again, some of them don't ever control that because they're way too far out of the money. And that is what the other Greeks are factored into. So if we aren't 100% delta, meaning 1.1, we have other factors that are added into that. So all 5 of these, delta, gamma, theta, vega, rho, need to add to 1.00. That's why if this isn't 1, some of these other factors are going to be high. And this is just how the Greeks work. So they're always changing whenever the price is moving. So let's move on to the next factor. So this is going to be Vega. Again, the most important one, the one you should pay the most attention to. This one measures the change in volatility. So your price of the option is going to go up or down based off IV, implied volatility. Volatility is something that is when earnings season comes around. That's a factor of how much a stock can move at any given moment. Volatility measures at any given moment how much that movement can be, and when it's high, it's projecting or predicting a high movement, and when it's low, it's predicting a low movement. I talked about this in my previous video. When it's predicting low movements and it makes a bigger movement, option traders can make a killing, and the opposite can be said. When it's predicting a huge movement and it doesn't happen, option traders can lose a killing. This can happen during earnings season. So let's say, Tesla is predicting, I'll even show you right now, the options for Tesla are predicting this week alone a 100-point move. And I'll show you how to add that up right now. It's pretty easy. These options expiring 5 days away, if we put them on our screen, that is a $3,000 option, $3,800. So you have to put them both together, the call and the put, and that's going to show you the projected move for Tesla. And for some reason it's making me scroll all the way down, but we want to put them right kind of at the same strike price, so 680s. So those two 680 call and puts are projecting a 90-point move in Tesla. Here's where you make money, here's where you lose money. If it doesn't move 90 points, option traders are going to lose money. If it moves less than 90 points, option traders are going to lose a lot of money. But again, that's kind of the factor right there. If you know you can beat this move, that's where you try to get in. That's where you can really leverage these options and do well. But if you know it's not going to move this far, it's probably going to trade sideways, that's going to be scary for option traders, and you shouldn't be buying calls and puts in that scenario. Later in this video, I'm going to tell you what to do in each scenario, how to trade strangles, straddles, and debits and spreads and all that stuff. And I'm going to show you one key factor to tell you what's happening with Vega at any time. So as you can see right here, these are the 2 most important things I look at to know if I should be scared about holding this overnight or if I shouldn't. So implied volatility is basically the volatility of the stock. This is how much it can move at any given moment. Right now, there's a priced in volatility for Tesla to move 130%. That can be up or down, meaning Tesla could go to 0 based off what the options are pricing in. Right here is Vega. This is super important, guys. Check this out. This is 37. So every time this implied volatility goes up a percentage or down a percentage, you're going to lose or make $37. So if it goes up, it's good if you're holding options. If it goes down, it's bad if you're holding options. For example, let's say the price of Tesla or the IV for Tesla drops 30 points. Let's say it drops to 100. That would be 32 times 37. So you're going to lose $1,184 if IV just crashes on Monday, Tuesday, Wednesday, Thursday, or Friday. And again, the price of that option is only at about $5,000. So you're going to lose 20% value just from IV movement. Same could be said if this moves to 160 IV, which seems insane that the price of Tesla could move 160% at any given moment. But let's say 32 and 37. If we move up $1,000, you're going to make 20% in Tesla. So that is the power of Vega. That's the one I am most scared of for traders because I know they're going to get screwed over if they're not paying attention to this. Now let's move to the next one, which is Theta. And this one, again, screws over traders if they're not making or if they're not paying attention to this. Theta is the decay in option price every single day as expiration gets closer and closer. So like I said previously on this chart, all the white options, all the ones and this with the strike price below the green, those are going to zero. The reason why they're going to zero is because of theta. Theta is that decay every single day. And for option sellers, it's good, meaning if you're shorting options, you can make money every single day. But for someone who's holding options or trying to hold them for multiple days, it can really hurt them. So again, theta, we multiply this by 100 as always, and this is going to be 3.5 times 100, $350. Let's say this is 7 days of holding. You're going to lose $2,000, which is going to be a 50% drop from this. So if you just held this for 7 days like an idiot, you're going to lose 50% of your options value. But here's the thing. We only have 6 days till expiration. So every single day you're holding this, you're going to lose a lot more. And this is going to continue to go up and up and up. So the next day, theta could go to 4.5. It could go to 6.5 because you only have 5 days to lose $5,000. So again, theta can go up. These deltas can go down and they can be put into theta. Or the delta can go up and theta could go down. So these go up and down dependent on how the option's moving and if it's trading sideways. So that's why these can change as well. These numbers are always just mixing together with each other. So right here with theta, again, this could be $450 the next day. So be very careful holding things with high theta. And this is Amazon, Tesla, all the biggest stocks over $500 with high volatility. Those are scary. I'm going to show you better stocks to trade later in this video, but let's continue on the last Greek. This is rho, and this is going to be measures change. Let's see if I can move this. In option price when the stock price moves. And this is something I don't really look at. This is something I don't know enough to explain. As a trader, I really don't care about gamma or rho. It's really simple, guys. Gamma is less than $1 and rho is about $7. So with a price of an option that's $5,000, I don't care about anything under $10 when it comes to these Greeks. So that is why I don't really care about them. I'm not going to try to explain it. I'm going to tell you the better stuff, the stuff that's going to help enhance your option trading right now, and just forget about this. So the next thing I want to go over is the strike price. Strike price. So this is a big lesson for all those traders. What is the strike price? How does it relate to us trading? How does it relate to the option in general? So the strike price is just that price you're going to see on the left side of the screen. So this is relative to where the share price is. So for example, we could have a strike price of $670 while the share price for Tesla could be $674. So the strike price is totally independent of the actual share price of the stock going on. And what is very important here is, again, the strike price, if it's at the stock price, it's going to be at the money. So this green line would be the same strike price as what the stock price is. Very important here, if you're expecting the stock to move up, then you want to make sure your strike price ends up above your share count if you hold till expiration. So the closer and closer you get to expiration, you want to make sure this number is larger than this number. So that's very important for traders. But if you're not trading, what this does mean for someone who's just buying this option to possibly sell their shares is if they bought this 670 put for Tesla, this is the put section, they have the right to sell 100 shares of Tesla at 670. So very important. They have the right to sell at their strike price at any moment, regardless of if it's at expiration or not. But for traders, this is what it means here. So the strike price, we need a certain move to break even. And all break even means is that if this option expires at expiration, we want to make sure we get a 7% move. So if we don't get that 7% move, then we're not going to end up at the point we bought this option at. So if we bought this option at 45, we can only get our money back at expiration if we get a 7% move down. So that's what it means in terms of if you want to just break even towards expiration. But here's the thing, guys. If you get that 7% move tomorrow and you still have time on the option, you're going to be making money instead of breaking even. So I don't even care what these break-even numbers are. I think it's kind of stupid that Robinhood puts them on here. What's more important is that you get the move before expiration. You know, this percentage break-even point just gives you a gauge of how much it really needs to move. And just from a number perspective, we have to hit $624 to break even once we buy this put. So that is the number in my head that the price needs to move to. Again, the strike price in terms of in the money, at the money, if we go further down on the option chain, they're just going to control less shares. So strike price is all relative to the current share price. And the closer you are to the share price, the more you control 50 shares. So going back to that chart, if we're at the green white, basically at the money, that's going to control 50 shares, around 50 to 60. If we're above that, we're going to control 50 to 100. Below that, 0 to 50. So that's kind of your gauge on what strike price is in contrast to what the option chain is right now. So what I want to go over is basically a scenario where we're going to be entering a trade and trying to get a certain move. And I'm going to tell you what happens if it doesn't move that way or if it does. So we went over everything in depth this far on what options are. Now I want to go over the execution, the scenarios, and I want to go over option strategies. Probably everything everyone's interested in, and probably why this is why they came here. They want to know spreads, strangles, all that good stuff. So first off, we went over the Greeks, super important. Vega can really hurt you if IV tanks. If IV pops, then that's good. You make money. Even if the stock doesn't move, IV alone could help you make money. Theta is an option trader's biggest nightmare. Again, we're losing money every single day, every single hour when we're holding options. And Theta just tells us how much we could possibly lose. And the last thing we went over was delta, so how much we're controlling in terms of the shares or the number of shares. So that's everything that matters for options. We went over the option chain. Again, this is what's more important too. The more time you have on your option, the more expensive we get. We didn't really go over this in terms of Theta, but the March 6 options, I'm just going to click in that 680. That's worth $5,200. If we just add 7 days to that, we're adding another $1,000 on that option price. So another $1,000 just in time decay. Again, let's add another 7 days. 14 days later, another $1,000. So 5, 6, 7. So we just keep increasing because of time decay. Time decay is making these more and more expensive. But as you see, time decay gets smaller and smaller the further out you go. This is because there's one simple rule with time decay. It gets faster, you lose more value within 30 days of that option's expiration date. So if I move all the way out to July, we're going to see those 680s being a ton. Let's move back a little bit. So April 680s are going to be 85, and you can't even buy them for some reason. Oh, there we go. So $8,500, almost 100% increase from where we're at now in March. So if we just add 30 days to that option, we're losing a lot. And again, there's Theta, $110 a day lost. And Vega is huge. We're losing about $82 a day. And IV is actually smaller for the ones further out. So again, all these Greek factors can change the further you go out on the expiration dates. But let's go through that one scenario of, maybe I'm bullish on Tesla this week. What can I make? What's the scenario? What move do I need? So let's just go very simple. Calls. I think we're going to pop in this market. I think we're pretty beaten up. I'm going to buy a 680 call. So let's head to tradingview.com and see the charts, see what type of move we need to actually make money. And I'm going to show you real in-depth what that looks like. So this is my TradingView setup. I love moving averages. I love volume profiles. I love Bollinger Bands. And here is Tesla. And I'll just do some technical analysis. That's some support we're getting on that trend line. What I'm hoping for is a move to this right before the gap fill happens. So this is going to be $732. So that is my ideal target for Tesla. And the reason why I knew that is because I study these patterns. I know the best ones. And I know that we're probably going to reject the gap fill. We're either going to move through it quickly or reject it. I'm more prone to think we're going to reject it. This is mainly because I've been watching the stock market for 5 years and I have 29 of the best strategies for $3, link below. This will really help you understand what I'm showing you right now. But these are my 29 bulletproof setups. Everyone's been loving the book so far and it's only $3, guys. So again, from where we are now, that's going to be 660 all the way to about 640. So 70-point move in Tesla. I'm going to show you really easily how much you can make just by looking at the option chain. This is one way you can kind of guesstimate how much you can make. So I just go down 70 points on the option chain. So we're going to go 680 all the way to 610. And we're going to see how much those options are worth. So these 610 options are worth $8,100. So just in raw mathematics, just using the option chain trick, this is something my best traders in my group know. If I go up 70 points, this option is going to be worth about 120% more. We're going to go from $3,800, and I'll even type this in. You're going to make about 213% gain. So let's try that again. We're going to make 113% gain. So we're just going to take the difference of it and divide it by 38. So 113%, bang. And all we did is just use the option chain to see how much we can make. A lot of people, they know time decay is important. They know volatility is important. So the best traders, if they don't get this move tomorrow, if they have to wait an extra day, they will use this one website to calculate how much they can make. And I do have this link in my option trading group, but this is something everyone should have. So it's under resources. And I do think you should be going to this website instead of doing my method, because my method doesn't work out exactly. But this is actually an app you can use on your iPad, iPhone, all that stuff. And it just calculates that option movement a little bit better than I would do it. So that just helps you know exactly how much you can make. So again, instead of 113%, it might actually be 70% if it takes 1 day to happen or 2 days. And that's why the app's going to come in handy, because it can actually look at all those factors that I'm not looking at. So for my example, if we get that 70-point move to basically almost gap fill and reject this line, that's going to be 113% return. That's pretty good in Tesla, but the problem is time decay, theta decay, all that stuff. And here's the thing, you could be wrong about direction, and then that's where you get in trouble too. So the worst thing about options, unfortunately, you have to be right about a couple things. You have to be right about the time. You have to be right about how fast it moves, the velocity. So this is expiring relatively quickly. So we basically need this move to happen instantly, almost 1 to 2 days from now. And the other thing that sucks is we have to be right about direction. So we have this 50-50 option here, either up or down. Again, puts down, calls up. But here's what happens, guys. You can make money from a lot of things that are hurting options. Again, I talked about this before. When volatility is high, you want to be shorting options. You want to be selling options. When theta is high, you want to be selling options. Just these two Greeks alone could make you, just add them up, that's going to be 320. So these two Greeks alone could make you $320 if we get 1 day of theta decay and we get one drop in IV. So if IV drops 1 point and we get 1 day of no movement in the stock where it just trades sideways the whole day, you'll make $320. Here's the thing, selling options. I talk about this a lot on my channel. Selling options is the key. I'm going to tell you everything you need to know right now, not as in-depth as my other videos, but something to let you know the power of it. So here's an example that's going to make the most sense. So on Robinhood, if you want to sell options, you have to go from buy to sell. And here's the problem. Everyone's going to ask this question. What is selling options? And more importantly, what's the problem with selling options? Because when you short something, it's very, very scary. Bad things can happen if you aren't prepared. So if you're selling a call, that's the worst thing you can do, guys, because that limits you to infinity and more of losses. Possibly you can lose everything in your account times 2, times 10. If you have a $100 account, you could lose $1 million by shorting options. Shorting calls specifically. Shorting puts, your downside is actually limited, which is nice. So again, why would you sell? What's selling a call even mean? So right here, our strike price is $6.80. The share price is $6.74. Every day, this option is going to lose money and trade sideways. If it does trade sideways, this option is going to zero. So $3,800 are going to zero in 5 days' time. I'm going to show you on this chart here. So this next scenario, let's say the price of the stock drops. And I'm going to mark 680 on my screen just so you can see it. There's 680. If we stay below this line for 5 days, you could make $3,850 with this option. So if I'm just going to sell this naked call, that's what they call it, naked calls, you're going to make that. And this is why you can make it, is because it says short call. It has a negative sign, meaning it's going to go into your account right away. You're going to have this money go straight into your account, $3,850 if you're shorting that. The scenario where you make all that money is if it does stay below 680 for the whole week. Stays below 680, doesn't pop above it, doesn't close above it on Friday. Here's the thing, it could pop above it on Monday. Let's say it goes up to 750. If it drops below 680 on Friday, you still could make that full amount of money. So that's huge. So even if you are wrong and it pops above it, you still have a couple more days to possibly get below your strike price. And again, this is the line that's called at the money. We want to be above this line for calls and below this line for puts if we're shorting options, because those are the options that are going to go to zero, as we've talked about. Right on this screen, you can see it too. Below the line, going to zero. Above the line, going to zero. Same thing on Robinhood. So right here, this short call, every single day is going to bring us in $290 passive income. Everyone loves that name and that word, passive income. Passive income is shorting options because you're getting theta every single day regardless of where the stock moves, regardless. Because here's the thing, if this even moves up, let's say it moves up $5, we're still going to make this $290 that day, just because the option's decaying. So selling options is passive income, it's no doubt. And the thing is, once you have IV high, selling options is even better because we know IV drops eventually. So if you are picking it at the right time, those are two things, two Greeks that are playing in your favor. So let's say we get a 10-point drop in IV. That's going to be 10 times 37, which is going to be $370. So that's going to be another $370 you're going to be making just from IV going down. So selling options, very, very attractive. Here's the problem. So you have unlimited risk to the upside if you're shorting calls, but if you're shorting puts, your risk is limited to 100 times the strike price, because that's so when you buy the option, you have the right to buy or sell 100 shares of that stock, depending on if it's calls or puts. But if you're shorting options, you lose the right. So you don't have the right to sell, because this is a put, you would have the right to sell at 680. You lose the right when you short it. So you're giving the right to someone else. If that's someone holding the other side of this contract, if they decide to sell their 100 shares of Tesla at 680, you're going to be the one that has to match that 100 shares for them to sell. So you're going to have to buy those 100 shares. So unfortunately, that's really tough for option traders, because at any moment you could be exercised and owe a ton of money. Just for example, 680 times 100 is $68,000. So unless you have that in your account right now, that can be pretty scary. So what happens when you get exercised? More specifically, what happens when you get exercised holding short options? So that example I just gave you, if someone exercised this option on the other side, they were holding it long, they will be selling you shares of Tesla at 680. 680. So you have to buy those shares at 680. Again, that's 68 grand when you were trying to make $5,000 selling this option. So it's a pretty steep price to pay if you don't have that money in your account. But again, what happens when you exercise and you don't have 68 grand in your account? What's going to happen then? Here's what happens, guys. It's not that scary, and that's why I want to explain it to you. If you're on Robinhood, I'm not sure if this happens exactly the same, but if you're on Thinkorswim and you got exercise, you would buy that on margin. So you would borrow that money from your broker, that 68K. You would sell that immediately after. So theoretically, you wouldn't lose any money because you bought and sold, and you got to keep the option premium. So as option sellers, you always get to keep the premium. So if you just bought and sold at 680 and you were out, and you bought at the same strike price and you sold it at the same strike price, you'd be all set. You wouldn't lose any money. Sometimes, the option moves after hours. Sometimes you're further away from the actual share price, so you might lose a lot. So let's just say you were forced to buy shares at 680, and then you had to sell them at 700. So that's going to be $20 you're losing a share times 100. So that's going to be, and I'm just going to put parentheses around, 20 times 100, I think we can all do the math, is $2,000. So you're still up in this trade because you got this 5 grand in your account, 52.43 minus 2,000, you're still up $3,200. But there's some crazy stuff that can happen after hours, pre-market, and you might not be able to sell it at that exact strike price, or even 20 bucks higher. Maybe it's 100 bucks higher. At that case, you're going to owe a lot more than you got for this actual trade. So there's some crazy stuff that can happen with exercising. A lot of people are afraid of it, but you really shouldn't be if you're on margin accounts, and you should just kind of be safe and worried, but just know that if you're doing puts, it's not as bad as naked calls, because losing is infinity for this one. You can lose so much more if you're just picking the wrong one, and the worst thing happens at the worst time. Now, this is probably what you're here for. This is probably what you're most excited for. This is going to be the option strategy section of the video. We're going to talk about how to trade spreads, what spreads are, what scenarios work best for them. So we're going to use, just for example, this Tesla setup here. We're just going to talk about spreads with Tesla. So normally, spreads help us eliminate the risk and profit from time decay. Because like I said previously, the problem with options is if you're buying, you're losing money with time decay, volatility movement, and you're selling, you're not protected. So you could lose a lot more when you're selling than that's in your account. So the best of both worlds is called spreads. This is when you're buying and selling options. Pretty cool, right? So here is the scenario. Let's say, for example, like I said before, I think there's resistance at 740 for Tesla. I don't think we're going higher than that. But here's the thing. I think we are actually going to move towards that range. So I'm pretty bullish on Tesla to head to 740. So I would be looking to get into a call scenario, a call spread scenario. And here's the graph that kind of makes sense of this all. So when we look at spreads, and we like to put them on charts like this to let us know where we're breaking even, where we're losing the most, and where we're making the most. So with a long call spread, what we're looking for is we're going to buy a call with the strike price lower, and we're going to sell a call with the strike price higher. The reason we sell that call again is when it trades sideways, when it decays, we don't lose money. So we're making money from the one that is selling, the option we're selling, we're making money from that decay, but we're losing money from the decay we're buying. So again, we're having two options, one's losing, one's winning. So cancels each other's out. Basically risk-free, we can hold it overnight now. So we don't have to worry about that time decay now. So again, as we move up, we're making money, and then we just max out there because we can't make money once our other call is in the money, as they say. So again, in the money is once we cross that threshold where the strike price meets the share price. But this whole portion to that moment is where option spread buyers are just going to kill it. So that is the golden point. But the worst thing can happen is you're wrong about direction. Again, being right about direction is very hard for anybody in the market. And, that's the game you're playing with options, unfortunately. So I'm betting for this to go up. And if I get to here, That's the most I can make. I'm going to set this up so that's my max profit. And my downside, I'll show you that in a second, but that is going to be limited because I am selling an option. So normally it's going to be limited to my investment of the option I bought, but because I'm selling an option, it's going to be smaller now. So it limits my downside, limits my upside by doing a spread. So I want to buy one that is, let's say, in the money or out of the money or at the money. The first option I buy doesn't really matter. So it could be any of these. Let's say it's a 660 call. I want to be selling, again, that option at resistance because I know personally this is resistance. I know it's a high chance we reject this line and drop back down. But I know also that we can run up to that line this week. So I'm playing everything and I'm playing the best of everything. I'm playing the upside. I'm playing sideways movement from options decaying. So 740 is my resistance. So I go to 740 and I press sell. I'm going to that option and I'm going to add it to my option order. So here we are. We have a call debit spread. As you know, debit, spending money, credit, you're getting money into your account. It's pretty cool to get money in your account, but this is the one where we're spending money. So right now we have a 660 call. This is going to be around 5 grand. Multiply this by 100 and we're selling this call here. So this just means that we're going to collect this full premium if we trade under 740 by the expiration date. So the best scenario here is that we go up, but we don't cross 740. And that's where you make the most money in this setup. So again, this costs you a lot lower than the initial call because of the call you're selling. So that just lowers the amount to get into this trade. But also that lowers your upside and basically puts a cap on your downside. So that call you're selling really helps you out as an option trader. So here's what would happen. So again, if we move to 740, which is ideal, it's a 70-point move. This option is intrinsically going to be worth 740 minus 660. And I can do the math, but I'm just going to show you on the screen. It's going to be worth 80. So that's going to be the option's value. So from 80 to where we're at now, it's almost 100% return. So let's say 80 minus 50 is 30. So 30 divided by 50 is 60%. So ideally, the most we can make in this setup is 60% return. But here's where it gets interesting. So although you make 60%, you're also making what this option decay is. So you're going to add this to that possible profit. So we're going to have 60 plus 17 now. 30 plus 17 is going to be about 47. So again, we're spending 49. Now we're closer to 100% return. And again, that cost to get in is 32. So the best thing I should have done is 80 minus 50. So 80-point move minus the $50 call price is 30. So we're going to make 30. Our initial cost to get in was about 32. So that again, 100% return if you're looking at it from that mathematical standpoint. So ideally, that's the best case scenario. We run up to resistance, we stop, and we make that money. Again, you make money in two ways in this trade. From that one option just dying, going to zero, and from that one option going up, straight up. And here's the most you can lose. Right there, 32, $3,200. That's the most you can lose. And what we're trying to make in this trade is 100% return. Most people know the best risk to reward ratio is around 1 to 3. This is a risk to reward of 1 to 2. We're not trying to lose, but it could happen, $30, and we're trying to make 60. So 30, 60, 1 to 2. You divide those numbers, that's a risk to reward of 1 to 2. That's not too bad. So that's a scenario called a call debit spread. And here's something cool. We can actually play the same move with something called puts. So we can trade a spread, a put spread, and play the same exact move. It's the same exact graph as that call debit spread, but now we're looking at a bull credit put spread, meaning we're going to get money in our account for this. It's going to be super exciting. So let's see if we can make more or less than our last scenario. So here we are with the puts, and what we're trying to do is buy a long strike price, lower, way lower, because that one is going to die off and we're not going to make money from when it goes to 0. But the short put strike price, we want that as high as possible because that one is going to 0 if we end up at 740. So let's look at Tesla again. So here we are. Normally, I don't like going in the money for selling puts. So I will go right at the money. So 670. So right here, I'm getting a total credit in my account for $4,500. But now I need to buy a put to limit my downside. So here we are. We're going to go buy, and we're going to go just slightly lower. And probably around there. So as you can see, it lowered the amount going in my account. So I'm not making as much from this trade because of that option I picked. You know, let's go even lower. Let's go to $600. But now that I went lower, my total credit is smaller yet again. So as you can see, if I go further up, if I go to the one right next to me, my credit is almost nothing. So the way you make money in this trade is you put that credit as far as possible because you don't want those strike prices close, or else you're not going to make a lot if you're correct. And that's also going to increase your risk in this trade. So you're going to lose a lot more money the further these strike prices are. So let's go to that 600 one just for example's sake. And again, if we go up at all, if we go up above 670, we are going to make $2,300 because both of these options are going to expire worthless. We're not going to have to do anything because we have the money in our account. $2,300, boom. And again, we don't even have to go to 740. We just go up at all and we're good to go. So that is the scenario where we can play puts to make money on this. But again, you're not making as much money as if you had that call spread, because that call spread's a little different where you can make money from the upside where it's, you know, it could be 10, it could be 1,000, it could be 2,000, but that short call is just going to help you basically lower that risk, and that's going to be collecting money every single day. But this one doesn't have that scenario where you don't have a variable of how much you can make. You basically are locked in based off this scenario, and you just don't want to go lower than 670 or else you're going to start losing money. And you might have to pay back that credit if it goes low enough. So I'll just show you the scenario where we dip down, and if we're wrong, how much do we lose? And it's pretty basic and pretty simple. You just subtract these strike prices. So 670 minus 600 is 70. So 70 minus 223 is 47. So you're going to lose about $4,700. So again, your total credit never goes up. That's the most you can make, but the most you can lose is always, you know, the variable. That's the one thing I don't like about credit spreads. I like debit spreads a lot more because we are playing the variable instead of being a victim to it. So that is the call debit spread, and that's the put credit spread. If we want to do the opposite scenario, we just flip it. So instead of going long on the first one, we're going short on the first one. Basically what we did for the put, but we're going to do it for the call. So I'm not going to go over this one. I'm just going to go over my last option trading strategy. This is just called the Strangle and the Straddle. And this is pretty simple. When we're looking for a huge move, or when we expect a huge move, if we just buy a call and we buy a put at the same exact strike price, we just need to beat this move here, so 90 points. So again, we need to move 90 points up or 90 points down from 680. I'm just going to show you what that looks like on the chart so you can get a feel for how the Strangle works. So 90 points down would be about 590, and that's not too far away, honestly. So that would be right about there. So we'd have to break that trend line, head lower. And for the upside, if we go from 690 all the way to 780, hopefully I'm adding this correctly, it's looking like that. So these are kind of the extent of where we're looking. And we just need to go above this line to make money on this trade, or go below this line to make money on that. So that's going to be a 100-point move. in any direction. 91 points, you're making money. 93, you're making money. So if you can predict larger moves that are priced in, strangles are an insane way to make money. And again, this is what people do during earnings season. And I'm going to show you one more trick. Ever went to optionslam.com? This is super cool. If you don't know the predicted move, you can just go to the earnings calendar and it's going to show you what the projected move for all of these earnings are. So these are happening after the close. And for example, we have a bunch of stocks over here and the projected moves are right here. 15%, 16%, 10%, 5%. So that's the projected move. And again, if that's not priced in the option, that's where there's some opportunity in the market. That's where it could be exciting. So if you can play that with a strangle, I think that'd be super unique scenario. So that's options in a nutshell. The last thing I want to do is give you a video that you're going to love. This is going to be my best small account strategy for options, and you're going to love this. Check it out. And today we're going to be talking about option trading, especially with small accounts, and the best way to grow an account this year in 2020. Some of these strategies I've